Friday afternoon live stream. This time of the week. How you doing, you magnificent melon heads? I hope you guys are well. Hi, Mom. Hi, Dad. I love you guys. I know you're watching. What a week, huh? Short week. Only a couple days. We had that nice holiday. Came back from San Antonio with a little sunburn. I had somebody refer to me as a sun-roasted melon. And one of my comments this week, got a little sun in Texas. That Texas heat is relentless, folks. And now we are here. Looks like the market took a little breather this week, huh? We're right around where we started the week. You know, climbed up a little bit earlier in the week, sold off a little bit, and then we've been trading sideways. After that monster rally we had last week, I'm starting to think this rally might be fading, and we could be resuming our downward trajectory very soon. So we're going to take a look at the charts and see what that is saying. Also, there's some really eerie stories that are starting to pile up in markets. I'm seeing some things, some quotes from bankers, some things that some CEOs are doing, a couple of stories. I don't like what I see in energy markets. I see very bad things in energy markets, and it's starting to make me think that we actually could have this, for lack of a better word, bifurcation in inflation. Right, we often hear the inflation numbers, the core inflation, which is when they strip out food and energy, and then the total inflation that includes food and energy. Well, I'm starting to think we could get a split between these two. We could see core inflation start to come way down, and of course our policymakers and our fearless leaders, and I use that term with total and absolute sarcasm, they'll start taking credit for core inflation coming down, even though the overall inflation number is going to keep rising or at least stay high because food and energy prices are going to keep going higher. And that difference is not going to be because of any policy fixing things. It's just going to be people can't afford to buy anything else after they buy food and energy. And so the price of everything else is going to have to come down. That's economic mayhem, folks. That is a miserable, like, doldrum of an economy to be in if that's where we're going from here. But anyways, we are going to shrink my big melon of a head, and let's take a look at what the indexes are doing right now. And it looks like the S&P is going to close in the red for the day. I'm not sure how we're going to end it. Right now, down 73 points, or about 1.75%. And I just want to show you on the 5-day chart here, we are just right now just barely above where we opened for the week. Actually, that's Friday. Let's see. Where did we open on Tuesday? Okay, we're actually a little bit below where we started the week, because remember, a 5-day chart takes us all the way back to last Friday. So we are in the red for this short week. Let's see what the Dow is doing, down 387, or about 1.17% right now. And the NASDAQ leading the way lower, much lower, down 340 points, or 2.75%. So the indexes are down across the board. NASDAQ lower than the rest. That's what we should have right now, because in a tightening monetary environment with interest rates on the rise and with money being sucked out of the economy, we should see the NASDAQ lead lower, because the NASDAQ tends to be made up of your high multiple tech stocks that are valued based on the prospects for future earnings more so than earnings this year or even next year. And so as inflation becomes a problem and as interest rates go up, that means those earnings are going to be less valuable in the future. So the NASDAQ should be leading us lower. Another thing I saw today that was very interesting is the 10-year Treasury yield. Looking right here, we are at 2.95, very quietly marching back up after taking a breather earlier this month. And right now, we for just a brief moment, let's look at a 1-day chart on the U.S. 10-year. For just a couple of minutes, we traded above that 3% mark today. And we came back down there, but that's an important psychological level, folks, and we haven't been there since mid-May. And, man, keep an eye on that debt market as those interest rates march higher, and we're coming up on more rate hikes. So, you know, we had this pullback as the market rallied. We had a little bit of risk-on mentality, but I don't think that is going to last as these interest rates head higher. That's very bad for U.S. companies, because, remember, U.S. companies are indebted companies, right? We're a debt-based economy. And we're a consumer-driven economy. We'll get to that in a minute. And as debt gets more expensive, these companies that, for all intents and purposes, should have gone out of business years ago, but they've been able to survive just by taking out new debt to pay off the old debt And every time they do that, their interest expense has gone down because interest rates have been declining for years, decades even. Look at your max chart here. Let's set this to 1 year, right? So that's what interest rates have done over the last couple of decades. But now they can't do that because interest rates are on the rise. And so that debt expense gets more expensive when they try to roll it over. So higher interest rates, bad news for U.S. economy. Let's set this back to 1 month. All right, now let's get into a little bit of the bad news that I was talking about. I saw a lot of things. First of all, a little bit of good news, right? I always do the doom and gloom. I get it. Jack is a perma bear, right? Check out this jobs number. We actually got 390,000 net job additions in the non-farm payrolls report this morning. That's a really good number, right? That's much better than I was expecting to see in this jobs number. So that's really good, all right? And just taking a look here, leisure and hospitality, this is where the jobs are on CNBC, added 84,000 jobs last month. That's really good, right? Leisure and hospitality, that's your hotels, that's your restaurants, that's resorts. People have been locked up for years. They're traveling again. So that's good to see. That's encouraging. Professional business services did well. Government, who cares? Transportation and warehousing did well. Healthcare's kind of inelastic. Now, manufacturing, this was interesting that I saw manufacturing was only at 18,000 jobs added. On the surface, that looks like very good news. We're adding manufacturing jobs. However, last month we added much more than that. I believe it was 40,000 manufacturing jobs were added last month. I'm sorry, it was 61,000 manufacturing jobs were added in April versus May. So now only 18,000 added this time around. So that is a big slowdown in hiring in manufacturing. We need that manufacturing here in the States because we've got this breakdown in globalism happening right now. Can't get parts in from overseas. The supply chain is broken. So we need to bring that manufacturing back here to the States. So to see a slowdown in hiring there, not a good sign. All right. And another thing that really made me nervous in this report is the one negative in this whole thing was retail trade losing 60,700 jobs last month. Okay. And this, folks, this is your inflation story. And this is where I was talking about that bifurcation going on in the inflation narrative, where you've got core inflation may start to come down, but overall inflation is going to stay high or even rise because people don't have any money left over after they buy food and fuel and rent. So there's no money left to spend at Target, to spend at the Gap, to spend at Home Depot. So you're going to see these retail numbers coming in. You know, this is layoffs at stores. It's a very bad sign because we are a consumer-driven economy, right? We're a debt-based economy and we're a consumer-driven economy. Almost 70% of U.S. GDP comes from consumer spending, the money you go to spend at the store and that you spend on Amazon. So a slowdown in retail, that's not good news for U.S. GDP prospects in the future. And I see Mr. Mike Binder from Robin RC Models. Thank you, Mike, for the super chat. I appreciate that, sir, very much. He says, this week I've seen so many positive prognosis, both in stocks and crypto in the news. That's interesting. I am not very positive on crypto at all. To me, it's a big bag holder scrambling for exit, liquidity for the margin man. An interesting theory, Mike, that the bag holders they're out on CNBC, they're out on Bloomberg, just trying to get the retail guys to come back in the market right before they rug pull. I can absolutely see that happen. Although, we had Jamie Dimon, we'll talk about him in a minute. They're not exactly all unicorns and rainbows in the financial press right now. But I mean, to see like Jim Cramer out on CNBC this morning or earlier this week talking about how the FANG stocks have nowhere to go but up. You've got to be kidding me with that noise, dude. They had one good week or 2 good weeks, and he's out there saying pile back into tech. You got to be kidding me. Listening to that guy is dangerous. Now, the crypto news, honestly, and I think I'm going to do a video on this over the weekend. I am actually very optimistic about crypto, but not for the reason you would think. I'm very optimistic about crypto because I don't think there's any good news on the horizon for crypto for a year and a half. All right? I don't think anything good is coming out of the crypto space until 2024. And that is very good news for you and me, Mike, because that means we can buy at a discount while everybody else is saying it's a scam and it's a Ponzi scheme and it's going to fail and it's going to zero and it has no marginal utility and it's thin air and all that. You know what? You guys can sing that song until you're red in the face. No problem. It's not your money. Me, I am going to just keep nibbling in Bitcoin. I'm going to keep nibbling a little bit at a time. I'm going to let the market go down. I'm pretty sure Bitcoin is going to head lower. It could head much, much lower. I've been talking about Tether really since this channel started, right? Tether could take Bitcoin down 50% like that if it ever really loses its peg to the US dollar. It almost lost its peg a few weeks ago. It lost it for a little while there, and then it regained it. It was $11 billion in redemptions in Tethers that have slowed down right now, but I'm not sure we've heard the last from them. I think for me, for Nobody Special's finances, that is very good news, because I will gladly continue buying small amounts of Bitcoin on the regular throughout this crypto winter. And then in 2024, the next time we have a halving and the payouts to miners gets cut in half, price is going to start rising a little bit. And people are going to notice the price is going to start rising, and they're going to start buying a little bit more. And with less in circulation and people buying more, that's going to trigger your FOMO rally, and we're going to rinse, repeat, and this cycle is going to happen all over again, and there's going to be this big pile in. The price is going to go vertical. It's going to attract the crooks and all the schmucks and the scam artists, and they're going to cause it to crash again. Rinse, repeat. It happens every time in this Bitcoin cycle. It's happened 3 times now. It's going to happen again. And it's the people who buy when everybody is saying it's a scam. They're the ones who get rich, all right? The people who FOMO in when prices go vertical, they're the ones who are paying for the scam artists. They're the ones who are walking away empty-handed, all right? Which one do you want to be? So I think it's very good news to me that there is no good news on the horizon for cryptocurrency. That's my mentality. Again, I use an app called Swan. If you feel so inclined, there is an affiliate link in the description to this video below. I'll always let you know when I use affiliate links. But again, I'm not piling in. I'm just nibbling a little bit at a time every week. And I don't look at price. I don't try to time markets. That is a 10-year horizon investment for me, 10 years plus. And I stand by my original call that Bitcoin at the end of this decade, the end of 2030, will be over $1 million. And that's because we have 2 halving cycles left in this decade. But thank you, Mike. I really appreciate the super chat, sir, and the support of the channel, as always. Thank you very much. And moving back on, where were we? We were talking about the retail trade. All right. And there's another thing going on with the retail trade that had me a little concerned, and that is the consumer credit in the United States. Check out this chart. Can you guys see this? You can. All right. This is consumer loans, credit cards, and other revolving debt here in the United States. And this is going back until about the beginning of 2020, right? Here in gray, this is the recession, you know, with the unfortunate health situation that every time I mention, I get my channel in trouble. So we had a big drop off in consumer debt throughout 2020 because people couldn't go out. They weren't allowed to go shopping. So they had nowhere to spend their money. Plus all the stimmies came in. So what they going to do? They got out of debt. And then early last year in the spring, as soon as the lockdowns were lifted, people started going shopping again. They started putting stuff on the credit cards. And that took a turn for the worst earlier this year as we went almost vertical in consumer credit debt. Now, luckily, this chart has at least tapered off a little bit, but we still have overall a slight uptrend in consumer credit. Now, keep in mind, the interest on this debt is going up every time the Fed hikes rates. The interest cost for all of these retail consumers to carry all of this debt is getting more expensive. We're looking at $864 billion in consumer debt right here. All right, the fact that this is leveling off coincides with the job losses in retail and with the bad quarters that Target is reporting, and with Amazon laying off warehouses, not laying off, Amazon subletting warehouses. Right, so the American consumer is getting squeezed by inflation, and we're seeing it in these consumer debt numbers. We're seeing it in these retail jobs numbers. We're seeing it in the quarterly reports from a lot of these retailers. And remember, the consumer is 70% of the United States GDP. So that is a very, very bad news for the U.S. economy. All right. Another story I saw this week made me a little bit nervous. I saw this today. Elon Musk wants to cut 10% of Tesla's jobs. All right. Pay attention to Elon Musk. And what does he say? He leaked an email today. Tesla CEO Elon Musk has a super bad feeling about the economy and needs to cut about 10% of jobs at the electric car maker. He said in an email to executives seen by Reuters. By the way, wonder why all of a sudden Elon Musk's fellow executives are ratting him out to the press on seemingly private emails I wonder if it has anything to do if they're, I don't know, maybe a little, they got their feelings hurt over Elon's approach to Twitter and letting conservatives have a voice on that platform. But I digress. The message sent on Thursday, entitled "Pause All Hiring Worldwide," came 2 days after the billionaire told staff to return to the workplace or leave, and adds to a growing chorus of warnings from business leaders about the risks of a recession. Tesla shares fell 9% in U.S. trade on Friday after the Reuters report. The tech-heavy NASDAQ was down about 2%. All right, so you've got Elon Musk now sees something really bad on the horizon. And Elon is not the only one. How many of you guys saw this story earlier this week? There's Jamie Dimon, the CEO of JP Morgan, my old nemesis from the silver trade. Let's close these out and check out this message from Mr. Dimon. I'm going to go on mute here so you don't get feedback.
It's a hurricane. Right now it's kind of sunny. Things are doing fine. Everyone thinks the Fed can handle this. That hurricane is right out there down the road coming our way. We just don't know if it's a minor one or Superstorm Sandy or Sandy or Andrew or something like that. And it's you better brace yourself. It's a hurricane.
Here comes the story of the hurricane. That is the CEO of the biggest bank in the world telling us there is a storm coming. He doesn't know if it's a little category 1 or if it's Superstorm Sandy. That's the biggest CEO, the biggest bank CEO in the world telling us there's a recession coming. And in the context of this, he was referring to two issues that drove him to say this. The first one he was worried about was the quantitative tightening. And if you're not sure about quantitative tightening, go back a couple days ago. I did a video explaining quantitative tightening. By the way, welcome, because I know I got a lot of new subscribers out of that video. Welcome, guys. Money is coming out of the economy, all right? Quantitative tightening. Let's not get too technical here. That is money destruction, right? The supply of money is going to be reduced by almost $50 billion a month. All right. Now, what happens to price when supply goes down but demand stays high? Price goes up, and the price of money is interest rates. All right, so this quantitative tightening that the Fed is doing, that is going to drive interest rates higher while they're already hiking interest rates. And again, we have a debt-based economy, a debt-based, consumer-driven economy. We've got a consumer that's being squeezed by inflation, and we've got debt that's getting more expensive. Oh boy, that is very bad news for U.S. GDP. Jamie Dimon sees it, and he's trying to get out in front of it, at least so he can say, I told you so, even though he's the embodiment of the easy monetary policy that's caused this whole thing. I guess I shouldn't say that. He's not a central banker, but he's one rung below a central banker. He's the CEO of the biggest bank in the world. So pay attention to that, all right? When you've got a guy like Jamie Dimon saying there's a hurricane coming, very, very bad news. All right. Something else that I saw this week. Actually, this just came out today. Oh, sorry, let's close those up. Putin says Europe's short-sightedness behind global food crisis. Putin says new sanctions to worsen the situation on the fertilizer market. All right, now this is just today. All right, he's having all of these discussions with the UN and with all these different organizations trying to get the Ukrainian grain out of the Black Sea. Right, there's hundreds of millions of tons of grain sitting in Ukrainian ports, and they can't get out because there's ships blockading it, there's submarines, there's mines, and everybody's pointing the finger at each other saying it's his fault, it's his fault. You know what? You guys go ahead and argue about whose fault it is. Meanwhile, people are going to starve. Well, there was some optimism this week in markets that maybe they're going to come to an agreement and they're going to let that food get out so people can survive. And if you ask me, that optimism is entirely misplaced. Because does this sound like a guy who is about to lift a blockade to allow food to get out of Ukraine? Europe's short-sightedness is behind the global food crisis, and that the new sanctions are going to worsen the situation in the fertilizer market? This is not a guy who is about to lift a blockade so people can get their food out. This is a guy saying, I'm going to leave my blockade in place, and the reason is because of what Europe is doing and because of what the West is doing. Putin's not going to let that grain out because he's going to hold it back. He is going to blackmail. And again, I'm saying Putin, and I'm using this very pejoratively. Look, I don't think our leaders are any better. All right. I think both sides wanted this war. I think they've done this to us on purpose because it conveniently gives them both somebody to blame. We can blame him, he can blame us, and their populations are pointing at each other all angry, and everybody's just letting them get away with it. All right, and I probably just got my channel in trouble for another 30-day timeout because I said that, but we must press on. So what I'm saying here is this big dip that we've seen in grain prices, particularly wheat, I think it's a little too much optimism going on there, and I don't think it's going to last. And by the way, speaking of grain prices, I had a conversation with a guy named Joe Vaklovic today, and he runs a channel called Grain Markets and Other Stuff. I got to send a shout out to my man Rich S., who is on my Discord server, who pointed me out at that channel. I did an interview with him this morning. It was a great interview, very informative about what's going on in grain markets and with that trade. I'm probably going to publish that one on Monday, so keep a lookout for that one. And Joe Vaklovic has a fantastic channel over at Grain Markets and Other Stuff. Highly recommend you check him out. Look for that interview in a couple of days. And there's my man T-Spin in the Super Chats. Thank you so much, T-Spin, for your support of the channel. Guys, I really appreciate all this. Thank you. I have the best subscribers and the best viewers in the world. You guys are awesome. No chat, no nothing. Just sends me a Super Chat. Thank you, brother. I really appreciate that. And there's my man Dakota Prairie again, also with the same thing. Thank you very much, Dakota Prairie. He says, do more podcasts on the looming real estate crisis. Interesting. More real estate. All right. Well, I think we're all going to be hearing a lot about real estate in the foreseeable future. But while we're on the subject of real estate, Mr. Prairie, Mr. Dakota Prairie, let's not forget that this is not only going to hit the interest rates in the 10-year Treasury, what the Federal Reserve is doing, right? They're going to be unwinding their balance sheet, quantitative tightening. Now, they're not going to be actually selling their assets. They're going to be rolling them off. As this debt gets repaid, they'll take the repayment, and then instead of going back into the market and buying more of it, which is no net change, they'll just be they'll be destroying the money, all right? So that sucks liquidity out of the market, and it makes money supply tighter, where they're going to be doing that not just to U.S. Treasuries, but also to mortgage-backed securities. That's, when you take out a loan with the bank, when you take out a mortgage, do you think the bank sits around and waits to get paid back a little drip, a little drab at a time? Absolutely not. What the bank does is they take that debt that you've just taken out with them, they package it up into a bond, and they sell it. Who do they sell it to? Your pension fund. Or, in the case of 2020, the Federal Reserve. Right? So the Federal Reserve owns all these bonds right now, and as they're maturing, they're just going to let them roll off their balance sheet. Well, that is going to have the effect of driving down the price of these mortgage-backed securities and driving up the interest rates on them. So what the Fed's tightening is doing, that's also going to add more stress to the housing market. That's going to make it even more expensive to borrow money to buy a house. And that's important because the cost of buying a house, even if the price of the house hasn't risen all that much in the last few months, the cost of the payments on that house has almost doubled since the start of this year. So with the more rate hikes that are on the horizon, and now with this quantitative tightening and the rolling off of mortgage-backed securities from the balance sheet, that's going to add even more upward pressure to real estate affordability. All right, now that's the key thing. All right, the key to the real estate market is not home prices. And I've talked about this before. The key to the real estate market is affordability. Can the people buying the house afford the payments? All right. It doesn't matter how expensive the house is. If the house is $100 or $100 million, if John Q. Public can afford that payment, he can afford to pay that price. If he can't afford that payment, then the price has to come down. Right. And right now, the prices are really, really high. We've had this spectacular bull run in home prices. And now interest rates on these homes have almost doubled. That means the payments on these homes have almost doubled. People can't afford them. People are being priced out of the housing market. And I'd also add another reason why these home prices went so high is because money that had no business in the housing market was driven there by low interest rates. All right. BlackRock, Vanguard, all these hedge funds, mutual funds, they've been going into the real estate market because they're starving for yield because interest rates were held so low for so long. And all these organizations, they have old clients that are on fixed income that need yield they can't get in the bond market. So they took that money out of the bond market and they put it in real estate. They got into the rental business, which, by the way, the rental business does not scale. I don't think this experiment is going to end well for BlackRock. Look what happened to Zillow and Realtor.com. Trying to scale up in the individual home rental business, I think that's a terrible idea. I think it's going to end very badly for them. Well, now as interest rates in the bond market are going up, I think some of that money is going to be driven out of housing and back into bonds. That's also going to have downward pressure on home prices. So I don't see a lot of good news on the horizon for home prices. And that, thank you again, Dakota Prairie, for your super chat, for your support of the channel, sir. I really appreciate that. And I will keep my eye out for additional real estate related content because I know you guys all want to know what the price of your house is going to do. I certainly want to know, although I'm not moving anytime soon. I like it right here. And then Mr. Charles Dowling, thank you very much, sir, for your super chat, for your support of the channel. He says, stand up for freedom of speech. Abso-freaking-lutely. Speaking of standing up for freedom of speech, I have a meeting set up next Monday with some of the good folks at Rumble. And I know you folks, a lot of you guys have been telling me that I need to get on Rumble. I think I will be getting on Rumble very soon because, trust me, folks, the censorship is real, all right? It is very real. I did a video not too long ago about something we might call the big do-over or the fantastic restart or the magnificent mulligan. You kind of know what I'm talking about here? Well, I did that video, and my channel had zero growth for precisely 30 days after I did that video. They cut me off. They didn't show my videos to anyone that wasn't subscribed to my channel for 30 days after I did that. That is very real, folks. All right? The censorship abso-freaking-lutely is happening, and I'm not going to sit around and wait. I am hedging my bets, if you will. So thank you very much, Charles Dowling, for your super chat, and I agree with your message very much. Stand up for freedom of speech. I don't do echo chambers, all right? That goes for you guys too. If you disagree with me, by all means, disagree with me in the comments. If I'm saying something and you think it's wrong, let me know. Put me in my place. Echo chambers do their occupants a disservice, all right? And sometimes if I say something and it's wrong, I want to know before I repeat it, and I'm wrong twice. I learn every bit as much from you guys. So freedom of speech is important, and that door swings both ways. So thanks again, Mr. Charles Dowling. And Mr. Bean Counter, all right. Got my little clapping hippo there in the super chats. Thank you, Bean Counter. Appreciate that very much with the GG and the applause going on there. That is outstanding. All right, guys, let's see. It is now 3:42. We've got about 18 minutes of trading left right now. Man, I've got a lot of windows open right now, and we have not gotten half of them. Let's see. Looks like the S&P is picking up a little bit, taking a little bit back as we go into close. Now down 64. Or about 1.5%. The Dow is now down 344, just over 1%. NASDAQ still having a rough day, but clawing back some of those losses at 308 down, or down 2.5%. 10-year Treasury still sitting at 2.95. Again, watch that 3% mark on the 10-year Treasury. All right, something else I really wanted to talk about today. Oil is kind of coming back into the forefront. Now, let me close up some of these windows here because I can't see what I'm doing. I have so many windows open. All right, crude oil. Check out this one-year chart on crude oil. All right. I mean, just straight up since the start of the year, we had that big spike in March that all the commodities had. Prices came back down, but hey, look, we're right back up. We're almost back at those March highs now, right? What did we peak? I remember I was landing in Philadelphia International, coming back from my trip to Dallas with the Economic Ninja and Chris Taylor and Joe Brown and all those guys. We had a fantastic meetup in Dallas. I remember turning my phone on and looking at commodities market and saying, oh my God, oil hit $134 a barrel while we were in the air. I couldn't believe it. Now we've come right back down since. But look, $120. West Texas Intermediate. When did that happen? We've just been creeping back up. And keep in mind, this is happening while production is supposedly going up. You know, OPEC Plus is supposedly increasing production. We're draining our strategic petroleum reserve. That's a heck of a lot of good that's doing. Oil prices keep going higher, folks. And remember, I was talking about it, that bifurcation in the inflation numbers. It's coming. We're going to see higher overall inflation, or at least high overall inflation, and core inflation is going to start coming down. If these energy prices stay high, people are not going to be able to afford this other stuff. And the other thing, because the consumer is being squeezed by food and energy, the businesses are not going to be able to pass on those higher prices to the consumers because the consumer doesn't have any money left after spending all of his money on food and fuel. So what's he got to do if he can't raise his prices, but his costs go up? He reduces his operations and he starts laying off his workforce. That's coming next. Again, not good for American GDP. And the other thing I want to warn you about is gasoline. Man, look at gasoline. $4.29. This is RBOB futures. Just straight up all year long. Again, we had a little bit of a breather, but look, gasoline is even higher than it was in March right now. All-time high, in fact. Let's take this out to the max it ever goes. Look at this. This is going all the way back to 2006. We are almost $1 higher than we were even at the height or right before the GFC. Gasoline prices just keeps going higher. Now, there's a couple of stories I want to talk about here because this is important, folks. Now, first off, OPEC got together and they said, we're going to increase our output, right? OPEC was supposed to increase their output by about 400 million barrels a month. Now they're going to increase it by about 600 million barrels a month. But guess what? Oil markets don't care. Here's the headline. This is dated today. Oil rises despite OPEC Plus output hike plan. Supply is still tight. Oil rose higher on Friday, supported by expectations that OPEC's decision to increase production targets by slightly more than planned won't have much of an effect on the tight global supply and by rising demand as China eases COVID restrictions. And that's an important one there at the end, that China is easing their ridiculous restrictions. Because let's go back to a short-term chart here. Look at a 3-month chart in gasoline. You know, right around March is when China put those draconian measures in place, and that did bring energy prices down a little bit. But now those China restrictions are being lifted, so Chinese fuel consumption is going to start reverting towards its mean. That means global energy prices are going higher. Now, there's another story that's important. Global refiners falter in efforts to keep up with demand. You see, to fight these rising gasoline prices, everybody is talking about releasing oil from their strategic reserves or having OPEC pump more oil. That is not the problem that's driving up gasoline prices. The problem is we can't refine enough gasoline. We haven't built refineries in decades in the United States. All the oil in the world is useless. You can't put oil in your gas tank. You got to refine it into gasoline first. And you have to refine it into diesel. And if you think gasoline is bad, wait till you see what diesel does to everything this summer. Check it out right here. This is in WJCT News. The astronomical price of diesel is making everything more expensive. We need to start building refineries in this country. All the oil in the world, it's useless. We need that gasoline. We need that diesel. And, you know, releasing this oil from the Strategic Petroleum Reserve, it has not had any effect. Gasoline prices keep going higher because the price of the gasoline isn't directly tied anymore to the price of oil. That's still an input. But the big deal now is the refiners can't refine it fast enough. Refining capacity is in decline worldwide. They're running overtime. And it's not like these guys are holding back because they are making stupid money at these refineries right now. The profit margins at American refineries and refineries all over the world has never been higher. Trust me, they are cracking every drop of crude they possibly can to make oil into gasoline and diesel. They're doing it as fast as they possibly can because there is so much money in it, but they just don't have the capacity to do it. And God forbid somebody tries to build an oil refinery anywhere in the world. My God, the crazies will come out of the woodwork. Oh my God, I can just see the headlines now and the ridiculous signs and the banners and the stupid publicity stunts. And there's Greenpeace climbing another building to hang a bulletin board or dumping baby seal blood on some executive. Who knows what they'll do? Because we can't build any infrastructure anymore. The crazies just come out of the woodwork. And unfortunately, the crazies are in charge, folks. If you can't do anything without the permission of the crazies, looks like the crazies are the ones who are running things. So until reasonable adults take over our infrastructure and our energy decision making, this will continue and life will keep getting miserable for all of us. Now, they'll blame Putin. They'll blame the weather. They'll blame this or that, unicorns and rainbows. They'll blame whatever. They'll blame anyone but themselves. It's them doing this. This is extreme leftist energy policy that's causing this right now. All right. Jack, get off your soapbox. And there's Mr. Mike Binder again from Robin RC Models. Thank you so much, Mike. Really appreciate the support of the channel, sir. He says the Dimon statement was taken out of context in the media. He's worried about QT, war, and high oil prices, and they just told everyone, brace yourself. Fed might end up buying back stocks. Fed might end up buying back stocks. You know, I was just talking to Joe Brown. I did an interview with him. It ran yesterday with Joe and Sage News. Great interview, by the way. I'm so glad to be able to get Joe on this channel. And he actually mentioned in his scenario, and he says he's putting together this video that he's probably going to put out next week. I'm looking forward to that, where he actually envisions a scenario where the Fed will probably start by buying up junk bonds and business debt, you know, using special purpose vehicles because it's not really in their Fed mandate. So they'll have to set up these little shell banks, I don't know, whatever, for lack of a better word, to start buying up commercial debt. And that won't be enough. And he actually thinks the Fed may end up starting to buy stocks directly onto their balance sheet, which honestly, the skin was crawling and the hair on the back of my neck was standing up as he was describing this situation, because it was, to me, it sounded like the Federal Reserve nationalizing the whole economy, and I don't want anything to do with a world like that. So it's interesting, Mike, that you should say the Fed might be buying back stocks, because that's very similar to what Joe described in the interview last night. So again, check that one out. It's on my channel right now. As far as taking it out of context, I didn't really see the press take it out of context. I mean, just about all the articles I read about it basically said what you said. He was worried about QT and the war. I didn't see so much about higher oil prices, but he did mention later on that oil has to go higher from here. But yeah, it's just not good when you have the CEO of the biggest bank in the world talking like that, describing a hurricane, an economic hurricane, and it might be a little one or it might be Superstorm Sandy. Get out of the way. All right, hunker down, get out of the way. Thank you, Mike, very much. I appreciate the support of the channel. As always, sir, you are awesome. And it was very nice to finally meet you, by the way, in the Patreon Zoom meeting that we had on Wednesday. Wednesday was my first Zoom meeting I had with my Patreon supporters. Ran into a couple of technical issues. It was the first time we ever did it, but we worked through them. My moderator, Mish, helped me out a lot on that. If you feel so inclined, I think I'm going to make that a regular thing on Wednesdays now. There is a link to my Patreon down in the description below if you feel so inclined. That is in addition to all the content I put out on the channel. Right, so there's not taking away at all from the channel in there. That's just something else I do. And because the Patreon is a much smaller group, it's a little easier to have the one-on-one back and forth. But that was a good time. It was really nice to meet you, Mike, and a couple of those other guys. Thank you for coming out for that. And while we were on the subject of energy, I also wanted to point out natural gas. What happened to the seasonal decline in natural gas that we're supposed to be getting this time of year? I don't see it in this chart, do you? Uh-oh. We are looking at an expensive fall and an expensive winter, folks. The price of natural gas keeps going higher. It's almost doubled since the start of the year now. And watch out for that one, because our grid is overly reliant on natural gas now. For the last 20 years or so, the United States has shut down a lot of coal, and we've shut down some nuclear, and we've replaced it with natural gas. And natural gas is not as reliable as coal and nuclear in the winter. It's fine in the summertime because nobody needs to heat their home in the summer. But in the winter, when everybody's got their furnace cranked up at the same time they're using a lot of electric, there's not always enough natural gas in the pipelines. And I was just talking earlier, you think it's hard to get a refinery built without the crazies coming out of the woodwork. Remember what happens when you try to get a pipeline built? They all have this big, expensive party, right, at the Indian reservation, and they talk about how oil is so bad for everybody. And then they leave all their plastic garbage behind for the Native Americans to clean up. That was nice of them, right? The EPA had to declare an emergency. Those protesters left so much of their crap behind, you know, to protect the environment. That's who's in charge of energy policy, folks. I don't write these rules. Hey, we get the leaders we deserve. What can I say? We get the leaders we deserve. All right, something else I have been watching very closely, although I haven't covered it as much on the channel recently, is what's going on in China. And I did talk about in my stream on Tuesday that China's banks are starting to show a little bit of weakness right now. There's some local banks in China that have frozen out their customers, and this ICBC is a much bigger bank in China, and they're starting to have issues with withdrawals. And I saw a couple of stories. First of all is this one. Fitch withdrawals rating on debt-laden China Evergrande subsidiaries. This was just yesterday, all right? Keep in mind, Evergrande has not paid their debt since, what, October? When did the Evergrande story start? Like September, October? Fitch just withdrew their credit rating from Evergrande. All right, what is it? 8 months after they defaulted on their debt. They didn't officially default on their debt. No. They went into their 30-day grace period, and then they said, oh, we're going to make some kind of other arrangements. And then they got downgraded to restricted default, which wasn't technically default. And then rather than actually declare them formally in default, Fitch just withdrew the rating. Probably because if Fitch ever actually declares them officially in default, the Chinese Communist Party won't let them do business in China anymore. That's just my guess here. But the reason I mention this, first of all, way to get out in front of that one, Fitch. Really, you guys are doing a bang-up job. Keep up the awesome work. Like, way to get out in front of that. Seriously. I am reminded of this. You guys remember this? That's such a great movie, The Big Short. I absolutely love that movie. I've seen it so many times. I could watch it again right now. It's just great, great movie. And they have these literary devices that they use in Big Short, right? One of them was like the girl who worked at the SEC. The promiscuous girl who worked at the SEC. She was literally in bed with the guy from Goldman, right? She was sleeping with him, and like literally the SEC was in bed with the banks. I get it. And one of the other more potent literary devices they used in the movie was that the ratings agencies were blind, as this character was so eloquently illustrating. And when I saw that Fitch had just removed their rating from China Evergrande now in June of 2022, the first thing that came to mind was it is this all over again. And then I also saw this one today. China's ex-securities regulator handed a suspended death sentence. Whoa, that's serious. A suspended death sentence for their securities regulator. Tong Daochi, sorry about my non-regional diction, is the latest high-ranking official ensnared in Xi Jinping's anti-corruption drive. And you know what? When your banks are failing and your economy is crumbling and your people are really upset and you're worried about them rioting, why not have a banker executed? You ever see that movie Gangs of New York? When the politician was saying, oh, people are upset about crime. I think we should hang someone. Well, let's just pick a banker and make an example out of him. So, but man, death sentence for their securities regulator. Wow. That's a big one. And, also, China raises pressure on banks to help their struggling developers. Property development lending has weakened despite regulatory calls, and the trend intensifies the real estate downturn and hurts credit expansion. You see, China's banks don't want anything to do with their indebted developers. I wonder why China's banks don't want anything to do with their indebted developers. I wonder why. And now it looks like the PBOC and the CCP is trying to put pressure on these banks to make loans to these developers. Why? I don't know. They obviously cannot ever possibly pay it back. So why give them more loans just to kick the can down the road? I don't know, maybe to help Xi Jinping get reappointed. But look, all these stories taken in a vacuum by themselves, not that big a deal, but you package all this up. China's economy is in really dire straits right now, and it all stems back to this ridiculous mother of all housing bubbles that China has built. And I could talk about it for days, but they're already starting to show signs of weakness in their banks. Keep an eye on that, folks. There is not a lot of good news coming out of China, economically speaking, anytime soon. And also remember, China consumes half of the world's concrete, half the world's steel, aluminum, copper. So this is not necessarily a good story for base metal commodities. I am overall bullish on just about all commodities, but I'm avoiding base metals because of the slowdown in China's housing market. And Mr. Steve Whitus, thank you, sir, again for the super chat. I appreciate the support of the channel, sir. He says, Jack, keep killing it, bro. Your analysis and insightful commentary is a breath of fresh air compared to the legacy MSM. Thank you very much, Steve. I appreciate that very much. I appreciate being described as a breath of fresh air. As far as the legacy mainstream media goes, particularly the financial press, look, they're salesmen, all right? They're trying to sell you something, all right? The guys that go on the mainstream press, they're either shopping their book or they're trying to get you to take the other side of the trade they're hoping to make, all right? I will always let you know where my financial interests lie. I've got affiliate links in the descriptions of all my videos so you know who's paying me. I try to be upfront and transparent about it as much as I can. And in the mainstream media, and especially on CNBC, they pretend to, but they fail miserably. But thank you very, very much. I appreciate the kind words, sir, and the support of the channel. And it is 4:00 now, folks. 4 o'clock. The markets are closed, and let's see. The S&P closed down 68 points, or 1.64%. Was that enough to be a positive close for the week? Wow, almost right where we started the week. Almost exactly. Ouch. Almost exactly where the S&P started the week. And the Dow, let's see what they did, closing down 349, or 1.05%. Dow just slightly in positive territory for the week, or at least higher than the open below the close on Friday. And the NASDAQ closed down 304, or 2.47%. And that is just above the opening for the week. So the market they managed to eke out a barely positive week, but certainly stalled this rally. I mean, let's go back to the S&P here and look at the rally that we've had. Let's go to one-day candles. This is your S&P chart, all right? So there's the head and shoulders pattern that started in December and into February. And you can see, we had that wicked sell-off in April and into the beginning of May. And then here is that dead cat bounce, if you will, or that market rally that we had. It went a lot further than I thought it was going to go. I have to admit, I was caught a little flat-footed by just how much steam this rally had. But you notice we're still below the 50-day moving average. And we're starting to already lose momentum. So market could break lower from here. We could have a little bit more upside. I don't anticipate any real heavy resistance until around the 50-day moving average. But with momentum already starting to stall, look, we've got a CPI read coming next week. We're in the quantitative tightening right now. So try to find the bullish macro conditions. I don't really see it, especially with the disappointing retail numbers and with the obvious situation going on with energy prices and with the consumer. So I just don't see a lot of light at the end of this tunnel here. If we do go higher, it's going to be because of the technicals, not because of any macroeconomic trends or any good economic news. But next Friday, we get that CPI read. So we'll see what happens. The CPI reading for May comes out on Friday the 10th. We are looking for that. We will go live for that in the morning, and then we'll do our Friday afternoon live stream again after that. All right. It is now 4:02, folks. I think I have been going long enough. We're probably going to wrap this one up here. It has been an awesome week. I want to thank you guys so much for your super chats, for your support of the channel, for watching. Also, a big shout out to my Patreon supporters. Thank you guys. You make this all possible. I couldn't do it without you. And again, if you're interested in that Patreon-only Zoom meeting that I do now once a week, there is a link down in the description below. The next one is going to be on Wednesday. And I think we're going to wrap it up, folks. Remember, I want you to have an awesome, awesome weekend. There are difficult days ahead, but they're not here yet. We got some beautiful weather out here. I'm taking the kids in the pool tonight. It's going to be a good time. And until next time, live small and dream big.